Hello everyone. So we have here with us Mr. Prabhakar Tiwari, the Chief Growth Officer at Angel Broking Ltd. So we'll be beginning our session on managing and growing personal finance. Mr. Prabhakar Tiwari is an experienced investor himself, so he'll be giving us his valuable insights. Over to you, sir.
Yeah, thank you, team, and very happy to be here in the FinFest. I'm told this is the last webinar, so I hope, as they say, save the best for the last. So this is the best input I can give you in managing and growing personal finance. So that's the topic for us today. Uh, what I suggest, you guys can ask questions to me during the session. In the, I mean, either you can kind of put in the chat window, or there is a mechanism in which the organizers will manage the questions coming to me. You can also follow me on Twitter. My handle is at sayspt. I'll be repeating the handle once in a while, and if you have insights and observations, you can write those down and tweet those using the hashtag FinFest and IITB. Also, just to make it interesting, the best tweet will get a chance to do internship with us. So just to kind of make you guys interested and giving you some incentive, right? I'll also be checking my Twitter once in a while, so I can take up questions from there also during the session. Okay, so let's begin. First, I would like to talk about angel broking. So, what I liked about angel broking 2 years back when I was kind of offered the job here, that the promoter and the CEO introduced the company to me, saying that meet the 30 years old startup angel broking. That's the best part about angel broking. So despite being in the business for last 3 decades, we're still as hungry as any youngsters out there. So about angel broking, we have roughly 8 million app downloads. We have 5 minutes average time taken to onboard client. So from the time you decide to open a demat account with us and the time you can go to kind of trade in your favorite equity share, it takes less than 5 minutes. 100% direct client onboarded digitally. So we are a digital organization. There is no physical process. You can do all the KYC and everything digitally with us. We have 3.46 million client base, which is a very large client base in equity market, in retail equity. We have robust network of more than 14,000 authorized personnel, or what we call sub broker. So this is our B2B arm. So we are available in 99% pin codes in the country. So we are actually covering the entire country. And the best part is that 75% plus of all orders are placed through mobile app. So that shows the strength of our digital infra and our app. More importantly, the way angel broking looks at future, the way we kind of find our purpose. Our purpose is that we exist to navigate new age India to meet their financial dreams. So we believe that we are a gateway to equity market. We are gateway to mutual fund investment and multiple other personal finance asset classes. And eventually we know that people chase their financial dreams, and we want to help them navigate that. Now, the interesting part is that if you look at equity market today in India right now, almost 70 to 75% people are coming from, less than 30 years of age, and almost 90% of them are coming from tier 2 and tier 3 towns. That's a large number. So equity market investment is no longer a metro or mini metro phenomena. Tier 2, tier 3, what we call Bharat, digital Bharat, is participating in large numbers. So we have the entire digital first fintech firm infra, from our angel broking mobile app to our ARC advisory, which is kind of a robo advisory, Angel B app, NXT platform for our sub brokers, and we have Angel iTrade Prime, which is an amazing discount broking plan for you. Rupees 0 for equity delivery and rupees 20 for intraday future and options, currencies, and commodities. And we have all these other supporting ecosystem in terms of smart API, where we help people who are into algo trading or even startups which are trying to build applications, so they can use the API which is available with Angel Broking. So we work in a kind of open architecture. And we also have our education initiative called Smart Money, where you can get a lot of content, whether you are a beginner or you are an investor or you're a trader. You'll get a lot of content which can really help you to get good returns from the market. And we have amplifiers influencer club. So if some of you are blog writer, or some of you are having your own YouTube channel or Instagram, you can actually register with us and you can be the micro influencer, and you can actually help us do content for our campaigns, and you will get paid for it. So this is a seamless digital infra we have. I just wanted to introduce you to these kind of infra with us. Now, coming to personal finance. Now, this is a very large topic. I mean, there's so much to cover on this topic. So, but still, I've decided to kind of keep it uh, in variety of subtopics, like in terms of giving you a quick intro about personal finance. We'll talk about the concept of saving and investment. I will particularly be talking about mutual fund, because that's easier for us to understand, and for any serious investor in the market, like mutual fund is an amazing financial asset class to invest in. So we'll talk about lump sum versus SIP. You'd have heard the term SIP a lot. If not, you will very soon once you start working and start getting your first salary. We'll talk about like which is better, lump sum or SIP, and we'll talk about the golden rules of finance. Moving on. So, personal finance at a glance. So, what is personal finance? I mean, if you look at it, very simple definition: how to earn, budget, spend, and save your money. Now, such an easy topic. Unfortunately, we are not taught about this topic in school, not even in colleges, and most of us learn it by trial and error. And by the time we learn it or master it to some degree, almost a decade of our life gets over, and an opportunity to kind of do it more systematic manner is lost. So that's personal finance. I mean, you look at it, it's about investment, it's about saving, it's about protection. So broadly, I'll tell you, personal finance can be discussed in this five broad topics, like income. Of course, I mean, that's the money you make from your job or your business, or if you have investment, if you have house, you're getting rental income, or if you have equity investment, you're getting dividend income. Then we talk about spending. That's important as well. I mean, how do you spend your money? What are the smarter ways to spend money? Personal finance is about saving, how you save money, how aggressive you are about saving. It's also about investing, how you invest, what kind of asset classes are available, how do you participate. It's about protection. Now, this is very important because we're talking about insurance. And I mean, all of you are young, I mean, uh, you have your dreams, your plans, and you might be thinking that why do I need insurance? But let me tell you that life insurance and health insurance, I mean, younger you are when you take it, more beneficial it is for you, right? So we will touch upon all these topics as we move along in this presentation. Now, this is very interesting thing. Like you talk about thumb rules, and there are a lot of thumb rules which are available. Now, this is one such thumb rule. Uh, like any money lover will tell you 50-30-20 budgeting rules. So 50% of your money should go towards your needs: housing, rent or food, groceries, transportation, bills and utilities. 30% should go towards wants: dining out, shopping, entertainment, travel. and 20% should compulsorily go towards savings, emergency fund, loan repayment. Now, I mean, these are just directional. I mean, they're it is just telling you that how much of your income should go under all these heads. You can always be more aggressive about your savings, and there are benefits of it. We will talk about it, right? But broadly, this is what you need to understand. Once you start earning your income, I'm sure it is such an exciting topic, to start kind of earning and spending your own money. But how you manage that money is also very important. And if you start looking at the broad topic under which you can budget and spend, you will be a better money manager, right? So I'm seeing a couple of people have start kind of tweeting and all. So I see a couple of tweets now. You can follow me at sayspt, SAYSPT, at sayspt, and you can write your observation and questions there, so that if you have any particular topic on which you want me to go deeper, I can take that topic in a deeper way, right? Now, if you look at personal finance, if I again talk about personal finance, right, it's all about budgeting and saving. How do you budget? How do you build an emergency fund? How do you kind of talk about debt and credit? How do you manage your debt to income ratio? How much can you dig out? How much home loan can you take? It's about investing, it's about stock market. Very, very interesting topic. Maybe we'll not be talking much about it today, uh, but because that's such a vast topic, and personal finance is beyond equity market, and creating your own portfolio, and housing decision. I mean, you are youngsters. Today the world is changing very fast. I mean, there was a time when I mean, at our age, we bought a house by the time we turned 30, and we paid EMI for major part of our decade, 30 to 40 age. But now people are not too much into buying a house. They are into renting. uh, Youngsters are putting more of their money towards experiences. And also, you will get to understand that it is better to pay lump sum for your house, or pay majority and take less debt, as much less debt as possible. Many experts differ in their views. Some people say that don't at all take debt. Some people say take some debt. I mean, leverage for home loan, you get tax benefits also because of that. So, but so there are, like, multiple thoughts around the topic. But important part is that you should be careful about taking debt, and should not speculate at all, in debt, and pay your credit card bills on time. That's a very important part. I mean, never take a loan on your credit card. That's the most expensive form of loan you can take. So this is what I mean, is important. Now, personal finance, as I said, is all about budgeting, in terms of like how you earn money, how you kind of spend money, how do you invest money, how much money do you save. It is all about that, right? So when you build a plan, the first thing you need to start, maybe at some stage, even when, I mean, with your first job, you can start that. What is your current net worth? To arrive at the figure, subtract your debts and liabilities from your total assets and investment. Maybe you will have zero asset, or maybe you'll have some liability in the form of education loan. But it is important for you to have a net worth kind of mindset. I mean, some of you may turn out to be the next Mark Zuckerberg, or Steve Jobs, or Elon Musk, or maybe closer home Ambani, Adani, or whatnot. But most of us will be middle class, but we have a chance to kind of create wealth, a sizable wealth, what is required for a good life, I mean, most of you are from IITs. That's a premier institution in the country. So you'll end up having a high income. But if you do not have this net worth mindset, I mean, you'll not be able to enjoy your money. You'll not be able to create a sizable wealth, because wealth doesn't depend on income. Wealth depends on investment. And for that, you have to have a net worth kind of mindset. The next thing you need to understand is, what are your financial goals? And that is very important part, because because somewhere, once you have the goals in mind, then you can work towards those goals, you can save towards those goals. Like, could be a short term goal in terms of buying a car or getting married, or maybe going to vacation in Goa, or maybe to Paris, whatever. Medium term could be foreign vacation. Long term could be educating and marrying kids, retirement, or whatnot. Maybe when you start your first job, retirement seems like a distant thing, I mean, like, which is far far away, I mean, maybe sometimes you may feel like a superman, a superwoman, that you will never reach retirement. But that's not the fact. The fact is that we grow old and we move towards retirement. But sooner you start thinking about retirement, the better prepared you will be. Let me tell you, many of the celebrities, be it Hollywood or many sports persons, I mean, they have amazing income. Like, their net worth sometime would be like dollar 600 million or whatnot. But many of them end up making disastrous, financial decisions, because they do not really plan their goals. They think that income will keep coming, but that's not the fact. Income is not certainty. It's not certain that you'll keep having income. I mean, many people have lost their jobs because of the COVID-19 unfortunate thing. Many people lose their job because there's a retrenchment in the company, or many companies get closed, right? So maybe there could be discontinuity in your income, but your expenses will continue to be there. So that's why it's important that you kind of identify your goals. And we'll also talk about emergency fund. Emergency fund is a very important topic. We'll talk about that. How much money do I need and when? Arrive at the exact figure by factoring in inflation. Now, this is very critical. I mean, our lifestyle, after a while, to manage the same lifestyle will require larger amount of money by the time you retire or semi-retire, or people talk about nowadays, being financially independent. So by what age you'll be financially independent, that decisions also you can start. I'll tell you something. I mean, I spend a lot of time in Twitter, and in Twitter there are a lot many people who are like experts in personal finance, or they claim that they are financially independent, and some of them are really, really, expert and very wise. You get to learn a lot about personal finance, or equity market investment, or mutual fund investment, or taking insurance from them. What I have seen, and what I have known is that there is a possibility. I mean, no matter where you start, if you're really, really saving aggressively, and if you have a plan, there is a possibility that you can be really wealthy, really rich in 2 decades. Some people can do it in 1 decade only. If they have a high income, they live within their means, and they save very, very aggressively. So, third point is that when you make a plan, how much money do I need and when? That is important, because many of the investment that you will do have certain period of maturity. For example, you can enter stock market, and your stock is a quality blue chip company, but even stock market goes through ups and down. And suppose you need money at a time when the stock market is down, then you will end up selling your stocks at a loss, or maybe you will not earn as much as profit, which is possible in that counter, in that stock, right? Or maybe you are kind of done a FD with certain lock-in period, or you have done certain other investment which has certain lock-in period. So the point is that if you're clear that you how much money do you need and when, you'll be able to plan your investment horizon also accordingly. How much risk can I take? High, medium, or low will depend on age, liabilities, income, dependents, investment, and work area. Now, some people say that how much. So, for example, if you have 100 rupees to invest, and if I ask you that what percentage of that investment kitty should go to equity market, which is supposedly more riskier asset class. then people say it should be 100 minus your age. So if you are say 20, maybe 80% of your investment kitty can go to equity market, but that's just a thumb rule. The important thing is that if you need some money 6 months from now, 1 year from now, then you should have some other more or less volatile, you should have a less volatile asset class in which you park that money or park or invest that investment, so that when you need, you're able to access that money. That could be useful for you, right? Also, please understand that when you are single, your liabilities are less, you can take more risk. When you get married, whether your spouse is working or not working, there will be certain other expenses which will get add up, your liabilities will get add up, and maybe your ability to take risk will become lower. Maybe after a kid it will still become much lower, right? So point is, risk doesn't mean loss. Let's understand that. Risk doesn't mean loss. Risk is about probability of a loss, right? Risk is about a certain volatile nature of an asset class. And that's a topic in itself. I can go on and on about talking about risk, but somewhere it's important that you start reading about risk, understand that which asset class, what kind of risk it carries. The more knowledge you have, there are more chances of you being smart money manager, and your ability to create wealth will increase that much, right? Where should I invest? Pick up from various asset classes like equity, stock market, debt, bond, multiple other kind of debt instruments are there, real estate, gold, cash, depending on your risk appetite and goal terms. So over time, and I'll tell you, many a time when because when I was preparing this, I just thought about what I could have known by the time I was in college, maybe first year, second year, third year, or fourth year, what I could have known which could have helped me manage my finances better. And I realized that when I was starting my career at that time, there was something I knew because my parents taught me and I've seen them investing, but there are many other asset classes which I was not very much aware of. And there was a fear that there's a lack of knowledge or I may end up making mistakes. So you have to act despite that fear, and you should talk openly about it. It's not about demonstrating how much wealth you have or how much income you have, or read about it. There are variety of forums, blogs, Twitter. There are many people who write articles, and Economic Times. There are multiple things which are available. More you read, more knowledge you will gather. And you should also do small experiments in each asset class, so that you build confidence, right? So this is how you can kind of build your plan, financial plan. It's a big topic in itself, but broadly, this is the framework in which it works. uh, Let me just check Twitter if I have any questions there. Okay, no questions immediately.
So there are some questions on the Airmeet chat.
Yeah, go ahead, ask.
So someone is asking, should I take a long-term SIP or keep taking short terms and convert them into lump sums upon maturity?
Yeah, so I'll answer that question. I have topic on SIP and lump sum. What is the next question?
So someone wants to invest in mid cap and large caps only. So is it recommended to distribute their investment in 2-3 firms for both medium and large caps, or should they invest in one medium and one large? They're talking about large and mid cap mutual funds.
Yeah, so we'll talk about mutual fund. So I'll answer both these questions. After a little while. Okay. So let me talk about savings. So remember your early childhood when your relatives gifted you money on festival. What was the first thing your parent told you? Put it in the piggy bank. And the habit of savings inculcated very early on Indian families. So how do I save? The first thing is, do not save what is left after spending, but spend what is left after saving. So this is important. This financial discipline is important. I mean, when you're young, you have no liabilities, you tend to be kind of, I mean, really, really, I mean, you do not take care of your spends as much. You keep on kind of spending money here and there. So that's not the right strategy. The right strategy is that you should make a saving plan, and after whatever is left, you should be spending. Start small, start early. Now, this is another important thing. Do I have enough to save? Doesn't matter. I mean, I'll tell you that it's not about you investing or saving once you start earning more. That doesn't happen. If you do not have the habit of saving and investing when your income is small, maybe you will repeat the same behavior even when your income goes up. I mean, because fundamentally, when you just start, maybe you will buy an entry level car. Maybe when your income increases, you'll go buy a high end car, right? So accordingly, you will upgrade your lifestyle, right? So if you have not followed a saving methodology, saving process, saving philosophy at an early age, there's a possibility that you will never kind of you'll never be efficient about it. What do I do with the sum? So, I mean, as I said, when you make a plan, you have to fulfill the goals, whether short-term goals, mid-term goals, long-term goals, and you have to prepare for contingencies. And contingencies can happen in multiple ways. Nowadays, people are getting diagnosed with lifestyle diseases at a very, very early age. And let me tell you, many of these things like cancer, heart attack, or multiple other emergency or medical conditions can really wipe out all your savings. I mean, some of these are like 5 lakh rupees, 10 lakh rupees, and all of that. So, my suggestion to all of you is please take a health insurance immediately as soon as you get a job. Maybe you'll take a less cover, but take health insurance immediately. Now, there's one thing you can take away from the session today, and if one thing I would urge you to take away from today's session is take insurance as early as possible in your life, because when you start early, the premiums are far lesser. Now, what is the benefit of investment? The real question is what to do with the money you have saved. And the answer is make your money work for you. And you can make your money work for you by growing your financial stability, realizing your dreams, and you can work towards a dream. I mean, if you have a dream for going 6 months European tour, at some stage in your life, start saving for it. Don't take a loan for it. Start saving for it. Maybe it will take you 2 or 3 years to reach there, but once you reach there, I mean, because see, if you take a debt and go for that European tour, you come back, you are paying interest cost, principal is getting paid lesser and lesser. You will end up paying much more, and the stress will be there of you taken a loan. But if you have a dream and you write down that goal and you work towards it, I mean, it's possible for you to kind of do it without causing much damage to your financial health or to causing any stress on you. Prepare for uncertainties, and then you of course have to promote the financial discipline. Now this is so what I have done is actually, I mean, I could have talked about a lot of investment options and all, but I decided to talk about mutual fund because that's easier for us to understand in the short time that we have together. So what is a mutual fund? For those of you who do not know, it's a financial product wherein the money invested by different investors is pooled together to purchase stocks, bonds, money market instruments, and other assets. So advantage of mutual fund is that you have a fund manager. So he will be taking those calls regarding where to put your money, for how long to put money there. So an expert will decide that, right? And mutual fund you can invest through SIP. SIPs are as low as like 500 rupees, sometimes even 100 rupees, 200 rupees, right? So you can do a systematic investment plan, and we'll talk about it. What is the advantage of mutual fund? Assist in achieving financial goals, the power of compounding, expert invest on your behalf, minimum capital requirement, liquid, easily redeemable in case of emergencies, and help you save tax. Okay. So I'll take on the question of mid cap and large cap. Can you repeat the question? What was the question?
Yes, sir. So someone was asking, is it recommended to distribute investments in two, three firms for both medium or large cap, or should they invest in only one mid cap and one large?
No, so basically, it all depends on what is the investment goal you have in mind. Okay, so the advantage with large cap is that your money is kind of protected because large cap are quality organizations which are mostly leaders in the sector they operate in. So, take for example, HDFC is a leader in the banking sector, or Infosys is a leader in the IT sector, right? So these company, when you kind of buy a large cap, your money is kind of protected in that way. Your risk is lower, but of course your upside is lower as well because large cap companies are already grown, and the growth percentage from there may not be significant. Whereas mid cap companies are basically those companies which are just in a growth phase. They are possibly number two, number three, number four in their respective segments, and there the upside could be much more because they are operating at a smaller base and in a high growth area. But the risk is also there that if somehow for some reason they fail, then your money your money will be lost. For some time there could be a loss. Like for example, when the COVID happened, most of the mid cap, even large cap, were in red. So those kind of circumstances, kind of risk is there in the mid cap. So my suggestion to you would be, it's important to have experience of both. You can actually take one SIP in large cap and one SIP in mid cap. These are financial advisory. I would suggest you talk to a proper financial planner for that. But what I can suggest you as a professional, but not an advisor, that's not my job. Advisor, I can suggest you that you can kind of do two SIPs in large cap and mid cap and understand how they behave, and then kind of develop a comfort level, right? What was the other question?
The other question was, just a second, sir. Should I take a long-term SIP or keep taking short terms and convert them into lump sums upon maturity?
Yeah. See, SIP. It's better to take an SIP, because we'll talk about SIP and lump sum just now. So I'll answer it after that. So in terms of lump sum investment, what happened? One time investment in a mutual fund of your choice. You do one sum. Like I have 10,000 rupees, and I have 10,000 rupees because I just got my monthly incentive or quarterly incentive. So I put that large capital to a mutual fund scheme immediately. So while lump sum, because you reap benefits of compounding, economical to invest in dips. Also, it can also happen because if there is a market requirement. Say, take for example, I also do SIP in index fund. So I do for Sensex and Nifty 50. So when I saw during COVID time, the index fund was down. So though I put certain SIP, monthly SIP there, I saw an opportunity and put some lump sum amount there. Why? Because there was an opportunity, because the market was at low at that stage. So who should do lump sum? Basically ideal for those who are willing to block larger capital and willing to take moderate or high risk. Recommend when markets are growing in a linear trend. Appropriate for people with larger but irregular income. And yes, there are certain, like for example, you are running a business, right? I mean, unlike a salary class where you get a monthly income, the business may go through ups and downs. Ups and downs could be that there could be period of no income or low income, and there could be period of very high income, right? So in those cases also, lump sum is advisable. Appropriate for later stages in life when one has larger savings, right? Because maybe when you start, you have lesser income at that juncture, and after taking care of your needs, which I discussed with you early, you don't have much left. So what you do SIP at that stage, and you don't have much to give as a lump sum. But as you kind of grow in your career and you start having higher incomes, you have a larger savings opportunity, and you can actually go for the lump sum. Now in terms of systematic investment plan, so systematic investment plan is like a fixed amount invested in a pre-decided duration, typically monthly, assist in spreading capital investment over a longer period of time. Now, please understand that none of us are market expert. I mean, nobody is a market expert. Even Warren Buffett will not say that I'm a market expert and I exactly understand when the market will rise and when it will fall, right? So the best advantage you have is that you do SIP, that on a particular day in a month you put that amount in the market. So over time, what they say, you will get the average dollar return. I mean, you can average out. So sometimes the market will be on a high, or the mutual fund scheme, that your that net asset NAV there is high, on a higher side or lower side. But by doing a monthly systematic investment, you spread your average cost of ownership of that financial asset. Affordable with a minimum investment of rupees 500, which all of you can afford. I mean, some of you can afford from your pocket money also, for that matter, and some of you might already be doing it. Average net asset value over a period of time. Seeking to inculcate financial discipline and can be matched with timelines and goals. That is critical. And timelines and goals could be like, you can put some money, say for example, I was talking about a 6 months backpack tour of Europe. You can actually make that as a goal and start investing money through SIP with that goal in mind. So you'll actually take those mutual fund which are like slightly more stable, or maybe during the initial year of your investing, you can go for a more aggressive and risky kind of mutual fund schemes. But towards the closure of your goal, I mean, eventual period of vacation, you can move to a more stable mutual fund schemes. The uninitiated are not required to time the market. Appropriate for people with regular income flow. I mean, this is critical part, right? And can commence investment very early due to minimum financial commitment required. So this is the advantage of SIP. So the question which has come, I mean, the simple answer is that SIP is more recommended. However, if you see an opportunity in the market where the market is like not bloated, is not on a high, then you can do lump sum also. It totally depends on which financial asset and what is your reason, for investing, right? Again, let me repeat. I am on Twitter at sayspt, SAYSPT, at sayspt, and you can follow me there and put your questions there. I can take questions from there also. Okay. Any more questions?
There are a few more questions. Would you like to take them at the end or right now?
No, just go ahead. Ask the question. It also giving me a
Okay.
sense of the audience level of knowledge, so that I can kind of talk about more complex topics. Yeah, go ahead.
So someone is asking, what is the current market scenario and what is your view on investing in the PSU sector like BHEL, BAIL, coal, etc.?
Okay. See, the current market is, I mean, we are destined to have, 1 lakh Sensex, value, in due course. And, we are very well poised. The unorganized sector is getting more organized. The financialization of assets are there. People are real estate prices are not booming wildly. So people are putting money more in equity market, particularly because the FD rates, interest rates are very, very low right now. Gold is also on a high, but not really increasing, not giving great returns. So people are entering the equity market. And I would advise PSU, because this market, this particular government is very serious about disinvestment. Some of the PSUs are really unburdened from the shackles of bureaucracy, and they can really compete well in the market. So take for example, even companies like SBI Bank particularly is doing very well. If you look at SBI Bank, and this is not a recommendation, let me kind of make that disclaimer, this is not a recommendation. SBI Bank is particularly doing well because people now have realized that government is reducing the number of public sector banks, and SBI, because of the kind of reach they have got, and I mean, they are well poised to kind of get all the benefits as the per capita income rises. Yeah. Any other question?
Yes, sir. So someone is asking which is more safer, gold bonds or bond issued by NBFCs like PFC or equity market or mutual fund? Yeah, they want you to elaborate a bit in terms of safety, return, and volatility.
Okay, let's take it towards the end. Okay, it's a very specific question on gold. So now let's talk about SIP versus lump sum. So as I said, both have their own advantages. Choose wisely. I mean, it depends on investment objective. It depends on capital available. Uh, it depends on regularity of income generation. For a business class, maybe a SIP may not be a good option because of the, as I said, the income, kind of may not be regular. Risk tolerance is also important. If you make a big mistake in your understanding of the market, you are putting lot money at risk at once in lump sum as compared to SIP. So this is also important. And then expertise in timing the market. To be honest, nobody is expert in the market. Even people who have 2 decades of experience will not say that they're expert in the market. Even I keep listening to Mr. Rakesh Jhunjhunwala, who is a very seasoned investor, and he'll also accept that he has done plenty of mistakes in the market. And another thing that I want to tell you about market, that uh, more than the return on the capital, the capital protection is important. I mean, you should take those risks which doesn't wipe out your capital, because if your capital is wiped out, you're gone from the market. But if you are able to safeguard your capital, and only put a certain percentage of it at risk, it is much better. Of course, for someone like Rakesh Jhunjhunwala, I mean, this kind of his ticket size, what he can risk could be in thousands of crores. For some of us it could be in lakhs, and for some of us it could be in thousands. Doesn't matter. So you should only risk that part of your capital which you are okay if it doesn't turn out that way, and you're not out of the market. Because to get returns in the market, you need capital, you need to be invested in the market. That's very, very important. No other this thing that I want to tell you, that start early, save more. I mean, like, for somebody starting investing rupees 5,000 in a month at 25 years, his corpus will be, say, um 1.2 crores by the age, they are like 60 years, right? For six somebody starting investing at 30 years, even with 6,000, it will be 90.3 lakhs. For someone starting at 35 years, 7,500 rupees a month, it will be 73.5 lakhs, and likewise. And even someone starting at the age of 45, uh, 15,000, the corpus will be only 52.8 lakhs. So you can clearly see that, I mean, this one third investment starting at an early age can give you a bigger corpus. And that is the power of compounding. And you guys are all engineers, you understand mathematics. Power of compounding, that's like the eighth wonder in the world. The power of compounding, I mean, till certain initial period, it doesn't look at all impressive, but after that magic happens, right? And even with a simple return which you can expect from the equity market of 12%, 15%, your money goes to a different direction altogether. So my advice, start early and save more. Now, let's talk about 10 personal finance golden rules to live by. uh, and I see few more questions. You guys can follow me in Twitter at sayspt, SAYSPT, and I mean, you can ask your questions there also. So, 10 personal finance golden rules to live by. The first thing is, be motivated and consistent. Now, this is very important. Let me tell you, you're all young. I mean, there's so much of life ahead of you. Some of you will get placement in your dream organization. Some of you might not get placed also. I don't know. That happens even in IITs and IIMs at times. And or maybe you will get placed in some company which you don't like as much, or that doesn't pay as much. Doesn't matter, right? We are talking about next 30 years of your life, 30 years productive life. And doesn't matter how you start or what you make out, be motivated and consistent. You have to believe that if you know the personal finance basics, you'll be able to make a sizable wealth. And I was talking about 2 decades. In 2 decades you can make a sizable wealth. I mean, in our country where the per capita income is low as compared to Western counterparts, I'm sure you guys are already above average because you're studying at IITs and you start with a good job. But if you can keep your motivation alive and you're consistent, you don't make, stupid mistakes, many mistakes. Of course, you'll make mistakes. That's also given, right? Then you'll be able to really make sizable money. Second part is keep track of your expenses. Now this is very critical. It's like a mouse inside your house. This mouse can kind of keep biting or destroying small things in the house. And if you do not take care of it, if you do not take care of the mouse, one day you will see that your house is unlivable. In a similar way, take care of your expenses. Understand what you're paying for Netflix. What have you taken? Like there's a Netflix 499 rupees, there's a Netflix of 149 rupees. Or how many times you go to Starbucks, or how many times you end up paying for the parties. All of that, those expenses you have to take care of. Because these expenses which will look small, like 150 rupees, 250 or 500 rupees, may end up making a big hole in your kind of in your in your overall wealth creation opportunity. Now somebody has asked a question. Rajan has asked a question in Twitter. Sir, I am a student who has started trading in all the stock market as well as invest in mutual funds. Do I need to file income tax return? Yes, Rajan, you have to file income tax return. And most of your broker will give you a kind of a P&L statement which you can use and talk to a tax consultant. There are startups like clear tax and all, which do not charge a lot for income tax filing. So Rajan, you have to kind of file income tax return, right, for profits that you're booking, for all your trading profit and all. Okay. So guys, you can ask me question in the Twitter at sayspt, SAYSPT. Pay yourself first. So what it means is that you should really put value to your time. You should spend money on your health and healthy things, insurance, those kind of things. It's very important part of personal finance. Open appropriate accounts and wrappers. See, this is important, right? Like for example, will have a saving account, you'll have FD account. There's something called PPF. PPF is another investment asset class, which is amazing. You should invest in PPF, and kind of the amount of return you get, and the long term benefit of PPF account is amazing, right? And you can open a demat account for equity. I will definitely suggest all of you to kind of start experimenting with equity market investment after you have understood mutual fund investment, and have a long term horizon. Over a long term horizon, equity will give you amazing returns, right? And this will compound your money as well. Spend less than you make. Now this is critical. Sounds easy, but spend less than you make, this is critical. Don't get into the habit of comparing yourself with others. Do not buy things which you cannot afford. Buying your home, any other form of the loan is not advisable. At least people who are very conservative will tell you that. So spend less than you make. You rather save money and buy it after 2 years. That 20 lakhs car, 2 years after you are able to kind of say make a down payment of say 12 lakhs or 10 lakhs, then buy. Then just kind of jumping into that right away. Pay back all your debt first. Now this is critical. First of all, always clear your credit card bills immediately. There's no point at all to kind of keep some kind of some sort of loans on your credit card. It is not at all advisable. It's a very very costly. there are other personal loans are available, at a much lesser interest rate as compared to what it will cost you on a credit card. Build an emergency fund and cash cushion. Now this is critical. Emergency fund could be like, it could be like 3 months of your income. Some people say it's a 6 months of the income. And people who talk about being financially independent, they say that they have 3 years of emergency fund. What does it mean? It means that even if they do not have any income for next 3 years, they can survive without selling their equity or their house or some other asset of theirs. So this building an emergency fund and cash cushion is very, very critical. This is this is one piece of advice that I would like to take away from here is build an emergency fund. That's critical, right? And it is surprising, like when you talk to an average investor out there, not many have emergency fund. But if you get into this financial discipline at the start of your career, I will tell you that it will safeguard you from many disasters in life. I know many of my friends who have to sell off their equity shares at a much lesser price when the market was down, just because they didn't think of keeping an emergency fund. Have multiple streams of income. Now I don't know how many of you have read Rich Dad and Poor Dad by Robert Kiyosaki. I read it like at a very early stage when I started my career, and I was amazingly impressed. As hard working as you are, make your money work harder. So have dividend income, stock market dividend, or have a rental income, or like, so whatever, like, so plan in such a way that you also have a passive income sources. Apart from the salary income that you have a passive income sources as well. Invest wisely, which means that you have to upgrade your knowledge and you have to talk around and understand how things are, and learn about pensions, insurance, and wills. Now when you start your career at the ripe age of 21, 22, pension or retirement will look like a distant dream. But believe you me, the more you are knowledgeable about it, the better you can plan about it. And there are a variety of things. Now there's a national pension scheme, there's a Atal Yojana, pension Yojana, there is PPF, as I said, and then there are PF, which gets compulsorily deducted from your income, right? So learn as much as you can. And nowadays it's very easy to learn. You just have to go to YouTube, type, and there are so many experts. Just listen to few of them, and after a while you'll start having a point of view about those things. And of course, insurance. Please take health insurance immediately as soon as you got a job. Your employer will give you insurance, doesn't matter. You should also take an insurance which you can carry for a much longer duration, right? Your critical illness will be taken care of, and this will always be a protection for you and your family in future. So this is all I had to share about personal finance. I could not go in depth in a particular area because of the paucity of time and the nature of the subject, but I could pass on as much I knew about personal finance and things. If you have picked one or two things from the session today, it will be very helpful. Now we can get into questions now. So shoot. Yeah, go ahead, guys. So let's get into the questions now.
So, sir, there is one more question that was initially asked. In the current market scenario, what is your view of investing in the PSU sector?
Yeah, go ahead. PSUs, well-managed PSUs are right now, they are undervalued. There are opportunities. It depends on the sector and the company, but PSUs would be a good buy in current market. Yeah, next question.
The next question is, can you comment on REITs in India, as work from home is in focus and around half of the rental comes from tech industry?
See, REITs are the current flavor of the season, and they seem like a good opportunities because there's a yearly payout, plus there's a chances of capital appreciation. And right now real estate is in very bad shape and at a very, very low valuation. So if you enter now, there could be opportunities because as the COVID has gone away, again the hospitality sector and other sectors will open up, and work from home will continue because that will become a regular feature. But The proportion will change. Maybe it will be 50% work from home, work from office. So the office usage in tech sector will also go up. So REIT, I would suggest, and there are like one REIT Brookfield has just gone, and there are more in the pipeline in next 3 to 6 months. Do consider it. Do read the offer document carefully, and then invest accordingly. Yeah. Next question.
So do we put stop loss in mutual funds as we do in capital markets?
No, I'm not heard about stop loss in mutual fund. To be honest with you, because there's nothing called automatic action in mutual fund. Stop loss is more for equity market. In mutual fund, you should have a fair expectation of returns, and small cap is very risky, but small cap also give good returns over a period of time. And the rest of the mutual fund will kind of follow the larger trends in the market. Yeah. Next question.
So should someone invest in SIP in sectorial funds like pharma, IT, or banking and financial sector rather than large or mid caps? Which one is better?
See, there are special themes. Pharma is one theme. Other tech is another theme. People also kind of go and invest for Nasdaq or emerging Chinese market and all of that. I would suggest that one should develop their portfolio of mutual fund over a period of time. Start from the very basic. Some people say that over a longer period of time, uh, it's very difficult to beat index. So S&P 500 for Western market, and in Indian market Nifty 50 or Sensex. See, and we are talking about a longer term duration. So if your long term investment, index, you start from the index fund, mutual fund, and make a portfolio with that, and then you should expand to like large cap, because large cap and index basically will behave almost in a similar manner. Then you should go for a special theme. So make a portfolio. Don't go with a greed that a particular theme mutual fund will kind of perform much better, and you can kind of bet on that. Don't bet on that. Have patience and build your mutual fund portfolio over a period of time. Yeah. Next question.
Please, yeah. So current equity market and mutual funds are an all-time high. Is it wise to put money now in these markets? And please share your views on stock SIP versus mutual fund SIP.
Uh, Stock SIP versus mutual fund SIP, I would say that both are important. Just that stock, you are taking a very narrow view of the market. You are just kind of putting it in one stock. So all the risks which are associated with that stock will also apply. So I would suggest that but there are certain stocks which are very very long term, like people talk about, and this is not a recommendation. You should do your own homework for this. Like for example, stocks like ITC, Infosys, HDFC Bank, which are a very long term blue chip, sectoral leaders. You can go for SIPs in them. SIPs could be for as low as like one stock, two stock, 10 stock, 20 stocks, or whatever, even 100 stocks, depending on your income. So there are more risk associated with a single stock SIP, whereas mutual fund is handled by a fund manager, and it's a less riskier thing. Yeah.
Okay. So there's one more question. I'm a first year student and I don't have much knowledge on investing and finance, but I'm interested in investing. What do you suggest I should do?
Sorry, come again.
So someone is asking that they are a first year student and they don't have much knowledge on investing and finance, but they're interested in investing. So what do you suggest they do? How do they start?
Just to start, start from a mutual fund. That's my suggestion, and then speak to financial advisors. See, in India, we do not want to pay advisors, but that's where the trouble is. If you do not pay the advisor, then there are commission structure in certain financial products. So somebody can misguide you to those financial products, which have huge commission but less return. Okay. So my suggestion is start from a mutual fund, and then once you gain certain knowledge and comfort level, then move to equity market, and put that money in equity market initially, which you are okay. Even you lose all of it. Lose 100% of it also. Like even Warren Buffett, if you talk to him, he will tell you that he has made most of his money uh, after the age of 45, then after age of 60, because of the compounding benefit. And he is mentally prepared that almost there's a 50% drawdown. Like if his portfolio value is 100 rupees, then he's also, it's a possibility that in a bad year it can, the 100 rupees can go down to 50 rupees or 20 rupees. But he has the staying power, he will remain invested, he will not panic about it, and that's why he will get the returns. So my suggestion is start from the mutual fund and then move to equity market. Yeah. Next
Okay,
question.
sir. I think these are the end of the questions as we have come to the end of our webinar now.
Yeah.
So I would like to thank you for taking this session. I think everyone had a great time, and a lot of their questions must have been answered in the domain of personal finance.
Yeah, thanks a lot. It was a pleasure interacting with you guys. I'm available on Twitter and LinkedIn. You guys can always reach out to me. And thanks a lot for your time, everyone.
Thank you, sir. Thank you for taking your time for this wonderful session.
Yeah, thank you.